Good morning, everyone, and thank you for joining us for today's Pareto Market Insights Investment Seminar. Today's session will be looking at cutting through what's going on in the world, how this is affecting markets, the investment decisions, and how this is affecting client portfolios. Together with Alex and Chris, we'll be looking at what clients should be doing today, how they can position themselves going forward, and what they should be thinking about with regards to their investment portfolio. One of the things we will be looking at, and it seems we've been talking about this for the last 18 months, is that volatility can breed opportunity. Volatility isn't always a bad thing. So it's important that any clients out there are looking at the funds that they're in, making sure that they reflect their attitude to risk and also their capacity for loss. We're fortunate today to be joined by our usual panel of experts. We've got Alex Brandreth, Chief Investment Officer at Luna Investment Management. Alex is responsible for running the funds at Luna, and he was named in the top 20 UK wealth managers by Citywire.
Yeah.
And we've got Chris Isaac, a Chartered Financial Advisor at Pareto. Chris sits on the investment committee at Pareto and specialises in advising clients and owner-managed businesses through accountancy connections. Chris will offer some valuable aspects of financial planning and views on the markets from an advisor perspective. So today we'll be looking at the impact of the ongoing conflicts in the Middle East, how that's affecting both the economy and the investment markets, and we'll be looking at what to do from an investment perspective, heightened during these geopolitical volatility due to the conflicts out there. Before we start, some housekeeping. To mitigate any background noise, can we please make sure that everyone is on mute? The presentation is being recorded and will be available online by the various channels. The presentation should last around about 40 minutes and there'll be a Q&A session at the end. Please feel free to ask any questions via the button at the bottom of the screen. And there's also an interactive poll that we'll be doing. This is the second time. Alex will set that up now and would ask you to participate in to try and get some valuable feedback. So we've heard a lot about interest rates and inflation. The markets have been trying to second guess what central banks have been doing and what's going to happen over the last 2 years of what's going to happen going forward. We're now, I think, at a genuine turning point for interest rates, but it could be that the risk of inflation becomes more persistent than what's expected. So can you just run us through what we think is happening with regards to central banks, interest rates and inflation, please, Alex?
Yeah, of course. I mean, morning, everyone. It's certainly been an interesting quarter. I mean, one of the reasons when we last spoke, we were very optimistic coming into this year because you had the potential for this year for interest rates coming down and you had fiscal stimulus from global economies. So principally in the US with the One Big Beautiful Bill, but also in Europe with the German fiscal package that they've announced, 500 billion euros. Astonishing. And then in March or the end of February, we saw the conflict in the Middle East start, and that's really started to impact. I've got a few slides that I think I'll share just to highlight it and go through it in a bit more detail and just talk through where we are. So just give me a second, sorry. All right, let's just go from here. There's too many things in my way now. Do you want to just talk from yourself?
Cancel it.
Yeah, and poll maybe. And the poll. And I'll share the results. Okay. Here we go. Over that. So I'll come back to that maybe in a little bit. But this is the crucial stuff really. 20% of global oil, 20% of LNG and 50% of fertilizer actually go through the Straits of Hormuz. And with its closure and that's having a big impact. It takes around 5 to 6 weeks for cargo ships to leave to get to their destination. So right now is really the point where the last ships that left before the conflict started have just landed. So we're now actually at the crucial point for the global economy in terms of this is going to impact now. So I think that's the most important point. And I don't know if you saw the news this week, Lufthansa have cancelled a number of flights.
Yep.
You're going to see more of that over the coming months. And the longer this goes on, the worse the impact that's going to be.
Are you saying buy your insurance for your summer holidays now?
I am. The oil price has spiked. So the oil price has gone to over $100. It got to 120 at the worst point. We've been here before. We saw the oil price get to similar levels when Russia invaded the Ukraine. And we had inflation data out this week as well. CPI came out at 3.4%. Now, just to say, that doesn't sound like a big number, but if you go back to the beginning of the year, we were expecting inflation to be at the Bank of England target of 2% now. So we're at 3.4 and we should be at closer to 2%. And one of the big impacts yesterday was motor oil as being inflationary. I don't know if you've both noticed it when you go in to fill up your car. I certainly have. It's a lot more expensive nowadays than what it was. This chart's a little bit out of date. So, and I'm just going to, this is probably my favorite chart, and you know I'm sad when I have a favorite chart, but just to explain this chart, this is what the expectation was for interest rates in December 2026. It goes back to January of last year, and you can see, and I've highlighted where we are today in that red square. So we're at 3.75% of interest rates in the UK. And if you go back to January last year, the expectation for the end of this year was that interest rates would be around 4%. And as we went through last year, you can see that interest rate expectations for December this year gradually fell. And that's because, as we know, inflation was under control and interest rates were gradually being brought down. And as I touched on, like us, other financial investment professionals were confident that we would see 2 interest rate cuts this year in January. And this chart really highlights it. So you can see here, right to the right hand of this chart, that at the end of February, middle of beginning of March, the expectation was that exactly. So we'd have interest rates in December of 3.25. But as you touched on, Stuart, when the conflict started and we saw the impact on commodity prices, those interest rate expectations disappeared overnight. And it was actually expected at one point that interest rates would get to 4.5%. So 3 interest rate rises from 2 interest rate cuts. So quite the swing in markets in a very short period of time. Now things have moderated a little bit. You can see there at the end of that chart, the line has started to come down, but the expectation is that we'll still get 1 interest rate cut this year. 1 interest rate rise this year now by December. I don't think that will happen, but it does create a real problem for central banks when you have these conflicts, because as touched on before, you've got inflation accelerating, but when you're spending more filling up your car and spending more on heating, etc., that's a tax. It's a tax of us going out and spending more money, and it impacts economic growth. So there was data out a week or so ago from the IMF and the World Bank, basically saying that they expect the UK economy to grow by around 1% this year, and beforehand it was about 1.5%. So you're seeing that impact come through. I mean, that's not bad. I mean, it's not, we're not going into recession. We don't want to worry people, but it's not the strong growth figures that we saw and were expecting earlier on in the year. So you've got this awkward situation now for central banks where growth's coming down and inflation's going up. And the Bank of England and other central banks have got this target to maintain both. They want to have stable inflation, but they want economic growth coming through. So that's where we are. So this conflict's really kind of put the cat amongst the pigeons with regard to central banks. It's not just the UK, this will be globally felt as well.
And one of the things you mentioned there, Alex, was fertilisation, and fertilisers coming through the Straits of Hormuz.
Yeah.
In the Northern Hemisphere, we're going into the growing season.
Yeah.
So we need the fertiliser to come through to be able to grow, else that will have an impact on food price inflation also.
This is what we saw after Russia invaded the Ukraine. You saw the initial shock come through from natural gas and oil. And I'm going to come back to Ukraine in a second, and it's on this chart. But then you saw the secondary impacts of inflation as well. And it's not just that, but it's also wages. Nice. If you see an inflation running at 6 or 7%, you're going to knock on your boss's door and say, please can I have a pay rise? And that has an impact in terms of secondary order effects. So the longer this goes on, the greater the risk that the inflation becomes an issue again. Don't want to scare people though, because, and the obvious conflict to look at was 4 years ago, which was when Russia invaded Ukraine. And someone said to me, always be careful if anyone says it's different this time. But it's slightly different this time in that after, when Russia invaded Ukraine, we were just coming out of COVID. And you can see, this is the chart here. Inflation was already running at 5% in the UK because we'd had that bounce back from the kind of getting back to normal. At the moment, we're coming from a 2 or 3% base, so we're slightly lower. And also, if you reflect back, the interest rates were basically zero at the time. Today, they're at 3.75, so it's slightly different in terms of the starting point. But back to the beginning and what we said at the start, it's really important to focus on longer term because that war is still going on. It doesn't get as much headlines anymore, but what's happened since that war started, Europe had to change its whole natural gas supply to be able to develop and manufacture as it could do. You've seen businesses adapt, you've seen individuals adapt, you've seen countries adapt, and that's what you started to see already. So you started to see pipelines going across, which have been accelerated, and that will continue to avoid 20% of the natural commodities coming out of the Straits of Hormuz. So it's a risk, but and then you reflect on markets 4 years on, markets were at all-time highs, despite the fact that this conflict was going on still. So look, it's always noisy and concerning in the short term, and it flips around very quickly, depending on what Donald Trump tweets. But it's important to focus on those longer-term picture at times like this as well.
Good. So we'll discuss markets in a minute, and because the markets are actually quite strong if you look at the headlines. But Chris, with clients, when clients in the portfolios, they start seeing inflation going up, interest rates going up, you mentioned potential wage rise increases. What should clients be thinking about if they've got monies invested with ourselves?
Yeah, I think as Alex highlighted, and we've highlighted numerous times on this webinar, that it's trying to keep the long term in mind, because I think what we've seen, especially, and I don't know if it's a probably more recent phenomenon, with things happen very quickly. We saw it last year with the tariffs, that there was some really significant falls early on, and then there was one day in the US where the market was up 9% in a day. And the problem is in a weird way, it's reassuring that it seems to be all kind of at the whim of Donald Trump, that at the flick of a switch, if he changes his mind, maybe things can go back to normal. Obviously, I think this time's a little different compared to the tariffs. With the tariffs, it was a completely US focused, his decision, and he had all the power to switch them on and off as he pleases. I think, as we've seen recently with what's going on there with Iran, is there's obviously the other side to the situation, and it's all right if Donald Trump decides war's over, but there's obviously another side to it. But I think things happen so quickly that if you're making decisions or big decisions around coming out of your investments or going in or whatever, around times like this, it's really risky, and actually more risky than just doing nothing and sitting on your hands, because what might happen and what tends to happen is people feel that surely it's only going to get worse from here. What tends to happen is the headlines get scarier and scarier. It gets dramatized more, and then that's the point that people start to panic, maybe sell from their investments, and then it's days where suddenly Trump does turn around and say, actually we're best pals again with Iran. The markets will bounce, and if you're not in, effectively you've kind of locked in those losses, and it's harder to then get back in. So what we're saying to clients is, and I think as Alex said, it's you can't say this time is different, because there's it isn't always different, but actually we've been through countless geopolitical risks in the past. We've been through wars, we've been through oil crises, and you look back over the longer term, and the markets will find a way to get back to all-time highs. And we've even seen it in the last few weeks. I think if we were having this webinar 2 weeks ago, 3 weeks ago, it'd probably be a different feeling around. But it just shows that actually in a short space of time, you can recover. And then that's why trying to flip in and out of markets is a risky thing to do.
And just to interrupt, just on that, I mean, there's countless fund managers, there's countless investment professionals I've met over the last 20 years of my career, and I've not met anyone who's been able to get it completely right all the time. And these people have been doing it for the whole career. So the expectation that you can get the timing absolutely right on this is absolutely ridiculous. I mean, it's my favourite stat that the low in COVID for the stock market was the day that Boris Johnson put the country in a national lockdown. So who would have predicted that? I mean, it's impossible to get these things right on any particular day, because it's sometimes when you feel it's darkest and you don't want to make that decision, that it's when it's the best time to invest.
And one of the messages we always say is time in the market, not timing of the market. That's how we look at investing our clients' money. So just with regards to that, because a well-diversified portfolio, as a fund manager, you want to take advantage of some funds that are doing poorly, but anticipating that they're going to do well in the future, and you'll look at constantly rebalancing your funds, taking out some of the value of the funds that are doing well and buying the funds that may be underperforming and buying it at a discount.
Yeah, we did that. We've been doing a lot of that. I mean, it helps that last year and the beginning of this year, markets were very strong, and some of our key decisions really worked in our portfolios. So the key driver to our performance last year was emerging markets in Japan, principally. Over the last few years before that, the only thing people wanted to talk to me about was AI and technology in the US market.
So we'll get onto that as well.
Yeah, but it's nice to see that market performance broadening out. And some of the returns last year were astonishing. We had silver, which was up 60% in 4 months. The emerging
I'm asking you, sorry, Alex, for putting in, because silver and gold for the last 15, 20 years have not done anything, though, have they?
Yeah.
And so that's a prime example of where
diversification,
having a well-diversified portfolio, time in the market, not timing of the market.
Yeah, no, I mean, the gold and silver's really surprised people, because what the key change has been, and I think I touched on the last webinar, was when Russia invaded the Ukraine, all the assets in US and Europe were frozen, which completely caught everyone off guard. So what you've seen central banks doing is I'm not saying it's going to happen, but if they had a similar situation or environment, they don't want to have their assets frozen. So they've been selling down their US assets, their US treasuries, and they've been buying gold. And then as you buy gold and silver tend to be performing, correlated to each other, and silver's performed well. I think what surprised people in March is that gold and silver fell. I think that's principally for two reasons. One, because it had such a strong run over the previous kind of year or two. And two, people were just looking to do what you said and rebalance. You take profits on the areas that have done well, and kind of touching on it, we have been actively taking profits on all our positions over the last 6 months because they had done so well and reinvested them elsewhere. And silver and gold was an example of that. The other thing is that because oil price spiked, you've seen countries like Turkey, which have been forced to stop buying gold to try and protect their currency. So that's kind of the natural buyer that was there has gone a little bit in the short term. That being said, we think this is a theme that plays out for the long term. We can't see this changing. And the other side to it is this is a finite commodity. There's only so much you can get out of the ground. It's very difficult, expensive, and takes a long time to bring a new gold mine on. So it's not like there's any new supply coming anytime soon. And on the flip side, this demand is increasing every day.
So with clients, Chris, we're speaking to clients, and one of the biggest questions we're getting asked is, well, are the markets going to retract? Is it a good time to get into the markets? Are the markets expensive? Are they overpriced? What would you say to anyone listening out there?
A lot of the time for those questions, I don't know, because that's the truth. As Alex highlighted, it's certainly over the short term, it's so difficult to predict exactly what will happen with markets, whether it's a good time to invest. A lot of these questions are only answered in hindsight, and that's why we can only make decisions and advise clients based on the longer term plan. We're not trying to get someone in at the right time and then get them out at the right time. What we're looking to do is grow people's wealth over the longer run at suitable risk profiles. And that's where, I think certainly since COVID, in the last 6 or so years, the amount of events that have happened in terms of COVID itself, we've then had, Ukraine and Russia, but inflation coming before that. We've had countless things.
Palestine.
And I think, in a sense, some clients, I think, have probably started to realise that there will always be things to worry about in the world. And I think that's probably what I say to a lot of my clients. There will always be something to worry about. And if there isn't, I think I mentioned last time that the media will find something to worry about, because that's what sells newspapers. And so I think it's trying to look through that and look into the longer run. The question around valuations and is it a good time to invest if markets are at all-time highs and things like that. There's lots of evidence around actually investing at all-time highs isn't a bad thing. It sometimes feels like you need to buy low and sell high, but as Alex said, it's difficult to get it perfectly right, and that's where for us and for clients, it's around your time horizon. If someone's saying, is it a good time to invest and I need that money back in 2 years' time or 3 years' time? Well, probably not, because there's a lot less certainty. But is it a good time to invest if this is for my longer term future, 20 years down the line? Well, absolutely, because whatever happens over the next 3 months, 6 months, year, it will be very much forgotten about in 20 years time. And that's where, it's always about trying to think longer term, but having that, having that access to cash if needed, so that you're not having to sell at the inopportune times.
And I think one of the things that we advocate to our clients is make sure you look at your long-term goals, needs and objectives, and not at the expense of short-term volatility.
Absolutely. And I think, the process we go through with our clients where we are mapping out their lives over the longer run, what's always reassuring in times like this, and we've been doing it over the past, number of weeks with clients, is we're saying, when we're updating the valuations, and yes, they'd come back down initially, if we can still look into the longer run and say, well, based on reasonable assumptions, you're still on track to meet your plans, that can be reassuring for clients that, well, actually, there's a good chance it will bounce back and we'll get better returns over the shorter term because of where we are. So actually, if we're still on track, then great. So I think it's always about trying to keep the long term in mind, trying to, understand that it is really difficult to get the timing right. And as Alex said, you might absolutely nail it, that, on the way of the first decision, if someone on the 28th of February said, right, I'm going all to cash, it would have looked like a brilliant decision. But the hard thing is then 3 weeks later, when it's still looking like good decisions, a lot of the time, those people, are going to assume it's going to keep getting worse from here. What happens is it bounces back, and then they suddenly say, well, actually, it's going to get, we'll go back down again. And next thing you know, as we said, we're back at all-time highs in markets, and suddenly you're back where you started. And had you just sat on your hands, you'd be in the same position with probably a lot less stress because you've just been able to focus on other things.
And I think at times like this, people focus on growth and gains, but sometimes at the expense of dividends. So when we're looking at the markets, we mentioned it before, you have a look at the FTSE, you have a look at the S&P 500, the Euro Stoxx 50, the Nikkei. These are close to all-time highs. The NASDAQ at all-time highs. And these companies will pay dividends, which a lot of the time get reinvested within the fund. So one of the things is when we're looking at touching on these large mega cap funds, why are they doing so well, Alex, compared to some of the FTSE 250, which still is having a little bit of difficulty?
The reason these AI technology names are doing so well is because they are so profitable. Their margins are huge. They print cash, basically. They've got no debt. They're starting to take a little bit more debt now because they're starting to build out and invest in more AI. Everyone wants them. I mean, I don't know about yourselves, but every morning you look at your Apple phone, you order your stuff on Amazon, you're on Facebook or whatever. Maybe not so much any of that nowadays. My kids are always on YouTube. But they just print cash, these businesses, and they've found different areas whether to be profitable, whether it be the cloud computing side and data storage. And the next stage is the AI revolution. And I think this year is the AI year of adoption, I would call it. Last year and the last few years has been about NVIDIA and people getting ready and buying the chips. And I don't think that's going away, don't get me wrong. But the next stage, and I know you guys use it a lot more, but we've started to use AI within the investment process, and what we're trying to do now, it's amazing at what it can do and how efficient it can be.
And I think you're right, that's affecting the working man in the street now, isn't it?
Yeah.
So even if you go, I had a plumber the other day that was fixing the boiler and he was using AI, and I'm going, but when the plumbers start to use AI for the work that they're doing, so it is getting into the individual day person.
No, absolutely, and it's the efficiency gains are significant. We're doing things that in minutes that we can do, but the thing I would touch on is just the accuracy, and that's the thing that everyone's got to bear in mind. So we've been using it for what we do a daily note. Sounds simple, but what's the key macro data that's happened? What's the key company results? And we're using the AI to do that now. So it saves me 10, 15 minutes in the morning. Still go and read, but it just saves actually writing it down. And just have to check it because it was telling me there was a Bank of England meeting next Friday, and no, it's next Thursday. Yeah. So it's just little things like that you just have to check and make sure that it's accurate. And sometimes it makes things up as well. So it's worth just being. It's useful, but it gets you. I say it gets you 90% of the way there, and then the 10% is the finessing.
I think as well, it's just going back over the past few quarters. some of the concerns that clients had in recent quarters was, is the AI in a bubble? Are things, those companies are valued, and very quickly with what's happened, actually valuations have come down, and suddenly there's something else to worry about. And I think it highlights that there's always something at that point in time that is front of mind, front of concern. But what tends to happen is markets change, markets develop, and I think I saw something that Exxon in the US, the big oil company, is now technically valued, or its valuation metric is higher than Nvidia, and it just shows that things happen quickly in the markets, and it's about, as I always say, keeping the long term in mind.
What's been really interesting, I think, this year, from maybe the last 6 months really, has been, you look at what the markets are doing in their all-time highs, but there's been a real rotation below the surface, and software companies have been under a lot of pressure. You just look at Microsoft share price as an example of that, and that's because it's kind of almost like the market is and the investors are expecting that these businesses are just going to disappear because of AI, and I don't think that's the case. What we've been doing is we're using Morningstar, so a data provider, to put it into AI. So we're still using that data provider, but it's almost like the market saying all these data providers are not going to be there in the future, like the London Stock Exchange and RELX and companies like that. So it has been interesting, and that again should maybe provide some confidence that it's not everything that's shooting the lights out at the moment. It's broadly based that the market's performing quite well.
And I think as well, a lot of what's happening at the moment, certainly the moves in the market, is more sentiment driven around what's going on. And as Alex touched on at the start, there could be some longer lasting effects the longer it goes on. But actually we're seeing that a lot of the big companies around the world, not just the US, are reporting growing earnings and growing ahead of expectations, even factoring in what's going on. So, and I think that's what we've spoken about in the past, that the long-term driver in the markets isn't sentiment, it is actually the earnings that these companies achieve over the longer run. And that's where, and I say it to clients often, it's stepping back and saying, well, is this war going to go on forever? And are these effects going to last forever? And will companies find ways to keep growing the profits? And
also bear in mind the value of companies. The markets are pricing in not the value of those companies today, but the expected value of where it will be in 6 to 8 months' time.
Yeah.
So the markets are expecting that what's happening in Iran, hopefully, fingers crossed, will get resolved. And then we've seen it when Trump comes out and says he's nearing a peace deal. You see the stock price of oil companies jump because they're expecting the movement for oil to start coming through the Straits of Hormuz.
Yeah, no, it's been volatile in both directions. We touched on March was a horrible month for bonds and equity markets. It kind of reminded me a bit of 2022 again. But then April's been strong again in terms of bond yields have come off their highs, equity markets have bounced. And you're right, it's almost like on a daily basis there's a swing depending on what's going to happen. And the oil price is the key driver to that. I think what concerns me, and I think the BBC did a really good article on it the other day, is about the people that are betting on these things before the information is being announced, and that's insider trading at the highest level. That really concerns me. But look, and you don't want people profiting on decisions that are made by a president before they're being announced. It's horrendous, really.
But one of the themes that we were talking about before the webinar started is volatility can breed opportunity. So when we do see the end of the Ukraine-Russia war, when we do see the Israel-Palestine conflict coming to an end, the Straits of Hormuz and Iran conflict, there'll be massive infrastructure, so people will profit from it. I don't mean to sound Machiavellian in any way, but companies such as Rio Tinto and massive construction, there'll be opportunities for some of the global oil companies to get involved in and around the world. And so these large mega cap companies, they will see this as an opportunity in the long term.
They will, yeah. I think the one thing from the conflict in the Middle East which concerns me is the damage to the infrastructure, particularly in Qatar. That's going to take 3 to 5 years to rebuild. So let's say if there is an end to the conflict, it doesn't mean that we're going to go back to where we were before. This just means we're going to have to deal with higher energy prices for a longer period of time until that's fixed. But you're absolutely right. There is that rebuild in terms of infrastructure that needs to come through. Companies will benefit from higher prices as well, but all companies are. Politically, that's not very acceptable, and they've already been mentioned, in terms of potentially an oil tax come through. God knows we're probably going to have to find some more money, because if more assistance is needed for heating in the winter, if things stay like this, then the government's going to have to do it, and then I don't know where they're going to go from to get the money from nowadays, unfortunately.
Good. It's obviously seen some kind of articles around potentially a bit of a move away from net zero. I think there was talk of drilling in the North Sea again, and do you think that's something that might pick up steam, that kind of, with all of the ongoing conflict? I think, as you mentioned with the IMF and OECD, that I think they highlighted that the UK tend to get hit hardest in these scenarios, and is that obviously one, it's concerning, but is that, do you think that's something that might drive a change of overall strategy, that's to kind of say, well, we need to better position ourselves in whatever way to kind of maybe dampen that effect?
I think you'd hope so. I don't hold much hope in the politicians to be able to do it, if I'm being honest. But I mean, you're absolutely right in that ironically, the country that's got out of this the best is the US, because they're energy independent and they've got oil. And
they've got Venezuela.
And they've got Venezuelan oil, exactly. So whereas ourselves, we're relying on importing electricity and gas and oil to be able to do it. And our energy infrastructure is old and tired. And these projects take decades. And that's the problem that we have, is that our political system is so short term, so that they don't think that it's going to benefit them to do these projects when it takes 10 to 15 years to bring a new nuclear site, etc. But it would be the right thing to do. We need to be more independent because, as you've seen, these events seem to be picking up on a quicker pace nowadays, and we can't always be impacted. And you mentioned the UK economy is the most impacted by this, as is Europe. So in the UK and Europe really need to adapt. Spain's probably the example. Spain, I think I read that this week, 70-80% of their energy usage comes from solar nowadays and renewables. They've just got fields of solar panels everywhere.
They've also got sun, though, Ali.
Exactly, yeah. I mean, that's one thing we don't have. Maybe we could turn the Manchester rain into energy. But there we go. But look, that's an example of a country that's pivoted their energy supply quite significantly, but we need to think and adapt as well.
And I think that's reflected in the debt to GDP.
Yeah.
And we have a look at how high that is. And to try and get that down, we can only increase taxes more, which everyone's battling against. We're already one of the biggest taxes that we've ever had outside of wartime.
Yeah.
Reduce spending. We've just been saying we need more spending on infrastructure.
Yeah.
And have a look at education and defence and NHS and energy. Inflation being a little bit high, that allows us to inflate away out of some of the debt.
It does, but it also means that you're paying more for your debt as well. So the cost of servicing your debt's high because of interest. And then if you've got any inflation-linked debt, which we do, then that means that there's higher debt payments on them as well.
So the only other way is trying to get some growth within the economy.
And that's what Rachel Reeves has been saying.
Yep.
But within every budget she does, but feels like every decision that's made is anti-growth, ironically. And I want growth, but it doesn't actually doesn't appear.
So that's where we are. What sort of positives can people be looking at? Because there's a lot of things that we've just been discussing with regards to volatility, and we keep mentioning that brings opportunity. It's time in the market. We've been here before, although it might not be exactly the same. We can work off the experience of the past.
Yeah.
What are the positives that anyone listening today can take out of where we are?
I think, again, taking a step back to where we were at the beginning of the year, we were positive because we had interest rates coming down, but then you have that fiscal stimulus coming through. That fiscal stimulus is still coming through in the US and in Europe. So that's one positive, that you're going to see more spending. There's also, we touched on defence, there's also going to be more money spent in areas like that. There is money going to be spent. The other one is that, yes, it feels like this is really bad at the moment and the headlines are terrible, but we're not going into recession, and growth has been hit to a certain extent, and inflation is going to be going up, but it's not going back to the 10-11% that we saw when Russia invaded the Ukraine. I don't know where it will get to because it depends on how long this goes on for, but it's certainly creeping higher. And there's a big positive that I've noticed and we've seen over the last few years is the ability to people to adapt to the environment we're in, whether it be countries, individuals or companies. And we've been here and seen this over time. And events like this create opportunities. We saw this last April. People didn't want to talk to me in April, May last year because of the tariffs that were announced and the impact it had on their portfolio and markets. But we were saying then this could be an opportunity, proved to be the case. FTSE ended up the year 25% higher last year. It's quite astonishing, really. And as Chris touched on, it's always a good time to invest if you're taking a longer term view.
And I think, Chris, when we're looking at clients' portfolios and annual reviews, we've seen some excellent returns. You just touched on it before, Alex. And when we're going out to see clients and they're going, everything what's happening in the market, expecting there to be some negative consequences, actually we're going out with some positive results on clients' portfolios.
Yeah, exactly. I think, as I said, had we been having this discussion 3 weeks ago, it might have felt different. But I think
is that why we rearranged the meeting?
Yes, yeah. But I think what tends to happen, and it's just how people's minds work, is when you've had a good spell and then maybe it does dip a bit, all you hang on to is that high point you reached, and it's evidence that people kind of feel falls bigger than they feel the winds. So it's natural that when there's times like this, and back in February you were at a high point, that if we're below that, even if it's 1, 2, 5, 10%, it feels painful. Even though if you then step back and go, well, actually we're only where we were in November, and in November we were all pretty pleased because we had bounced back from the last fall. So it's about having some perspective sometimes and keeping that longer term in mind. And I think I've highlighted this before, that these are good times to also reassess how you felt during these periods. And it doesn't mean we're through the end of it. But at the point that you were seeing the headlines around that and you logged in and maybe checked your account and it was down, if you felt, okay, yeah, this happens, that's part and parcel of it, well, it's probably a good sign you're in an appropriate portfolio. If you found yourself checking every 10 minutes or every time you saw a headline, maybe it is too volatile for you. And that's where, certainly not just reaching out to them directly and selling on, straight away, that's not the right thing to do, but reaching out to your advisor and being honest and saying, I felt pretty uncomfortable during that period. That then leads to further, are they invested at the right risk profile, or actually have they kind of had a reassessment of their longer term plan recently? Because sometimes it's just a case of talking through why we're doing what we're doing in the first place, and that can put clients at ease. So certainly it's, times like this, that it's good to reassess, but it is good opportunity. We have, tax year end's a busy time for us, and we've had a lot of people, adding money into markets, and it ended up being around the time that things started to bounce back. So sometimes it works like that, and it's just pure coincidence. Other times it's the opposite, but it's just about keeping the long term in mind.
And I think also for clients that are taking income, it doesn't have to be all in, all out. You can take some of it and just protect yourself for the next couple of years, 18 months, if you are feeling a little bit vulnerable with the markets.
Absolutely, yeah. Part of our kind of income strategies for clients is about having that cash buffer, which we've spoken about before. It really gives you options, it gives you flexibility, but it also gives you peace of mind that in times like this, or times where drawdowns are a bit more prolonged, that you've got a bucket that can fund your income regardless of what's going on in the market. So that's really about the planning and having that strategy set up in the first place, not just kind of blindly drawing from your portfolio. And that's where working with an advisor and kind of keeping on top of these things really helps.
Good. I mean, just going off track a little bit, one of the things that I'd just like to ask you, Chris, and it's not about the investment, so excuse me, Alex.
Sorry?
There was a change in change in legislation that came in on the 6th of April with regards to business asset disposal relief. I don't know if you just want to touch on it briefly, Chris, because there's also a change coming in pensions from the 6th of April next year, and how that affects the states.
So on the inheritance tax with business relief, is that
right?
Yeah. So yeah, we I think pretty much since October 24 when it was announced. Initially, we've been speaking about obviously the changes that were coming in, and it finally was put in place. There were some tweaks which I think we spoke about last time that were brought out just before Christmas, that they kind of did increase the limit, and this is the amount that business owners would be able to pass on death inheritance tax free. Used to be no limit on it. The limit was brought in at $1 million, was at the last minute bumped up to $2.5 million, and that's between individually. So, a married couple could have up to $5 million. I think
specifically a trading company.
On a trading company, yeah.
And it's worth speaking to your accountant to make sure you qualify.
Absolutely, and I think that's where we talk about markets, we talk about investment returns, but actually, the tax savings and planning for inheritance tax, things like that can have a far bigger impact actually on your longer term wealth than getting that extra 1 or 2% return, or maybe softening a drawdown, whatever it may be. And I think sometimes you can forget about that actually the planning around, and it's not the same for everyone. Everyone has different priorities. Part of what the planning process is about is finding out how important these things are to people. I sit down with some clients and, they pretty much say blankly, I don't want, Rachel, as they would say, to have any more of my tax. So, that plan for them will be that we're certainly going to be taking some proactive steps when it comes to inheritance tax planning, especially for business owners. But for others, it's, I've got time on my side. I'm happy to pay some tax, and it's a different plan. But there's lots of options out there for people with businesses, but also without businesses, as you touched on. From next year, less than a year now, pensions will be brought into kind of the inheritance tax calculation, and suddenly a lot of people that might not have even been thinking about inheritance tax, it could be £100,000 plus potential tax bill on second death. So again, that's where actually with some planning, that it's not just that we sit on it and it is what it is. With sensible strategies, we can save hundreds of thousands of tax, which, as we spoke about, regardless of what's going on in the markets, if actually with some good planning we can save a lot of tax, suddenly that 10% maybe that your portfolio has briefly fallen doesn't feel as much if you've been saving tax that outweighs that.
And I think that's where it's important, again, not only when you sit with your financial advisor to look at your risk profile and volatility, but also look at the tax implications of growing your wealth, because as you grow your wealth, there are bigger tax burdens.
Yeah, absolutely. Yeah, it's growing your wealth in the right tax wrappers is important. Pensions previously were the golden egg. If you grew it in there, that was the plan. But suddenly now, if it's great, your pension is growing, but actually, are you just compounding an issue that you might not want to be paying as much inheritance tax down the line? So it's really about always coming back to what's the money for, and that's not that's at all stages of life. Is this for a house deposit or for a new car? Well, you do something different with that if it's for gifting for grandkids and school fees down the line. So it's always thinking back of what's the money for. That helps drive the decision around do we invest or not, what tax wrappers we use, but then it also impacts the investment risk that we're taking and the portfolios that we use. Because if it is for the longer term, maybe it is for grandkids that aren't even around yet. Well, times like this are opportunities.
And also how we invest in the funds that Alex is running.
Yeah, absolutely. Yeah.
So we've got a couple of questions and answers. Excuse me. Sorry, we've got a couple of questions. I can't see.
With I've got mine on. With AI, how are Pareto approach the cyber risk for the company and their clients of cybercrime?
Yeah, so we've got Cyber Essentials, which is a kite mark with regards to protecting client information, first of all. We do use AI. We've got processes in place to make sure that that data is as secure as we can possibly get. I will not say that.
Just to reassure people, we're not plugging everyone's data into ChatGPT. No. We have very strict rules around what we can and cannot do with AI.
Policies and processes with regard at group level, and also about what we can use, how we can use it. But we've also got Cyber Essentials, which is a kite mark which says that there's certain restrictions in place and protects client data.
Yeah,
it's huge out there. I mean, one of the things we deal with general insurers, one of the things that we're talking at the moment, the biggest growth area within general insurance is cyber insurance. I know a company whose data was, it's a large multinational. The data got hit. We've seen it with Marks and Spencer's, Co-op, Jaguar, Land Rover. It was a company probably the same size scale as them. They were held to ransom for about 2.6 million. They had insurance. The insurance company paid out about 1.8. Actually, it cost them close on £3 million because of the business continuity.
Right.
So it's a great question. And anyone that we use as a third party, we always ask about what their data security is, as well as we would take them on as a partner.
Yeah, it is a growing risk. We're from an investment perspective as well. We invest in cybersecurity as a theme within our portfolios at the moment, because more and more people are looking to protect, and it's the one thing that you don't cut off. You're not going to reduce your IT spend on cybersecurity. If anything, you can say that we've all been underinvesting for the last 10, 15 years, and particularly with AI coming, it's a new threat. And what's interesting though is these companies are all sold off because of this software theme in terms of AI, because they're saying that these companies aren't going to be as profitable in the future because AI is going to come through and take it. And as I said, I don't think that's going to happen at all. I think if anything, so there is ways to benefit from an investment perspective. It hasn't worked out well over the last year, but it's for us, it's a long-term theme that we see coming through.
And I think you're right there with regards to all companies are using AI now, so there is some form of risk to data. One of the things that we have seen, national minimum wage increase. We've seen national insurance thresholds come down, and the cost of national insurance go up. So there is a little bit of a purge on profits within companies.
Yeah.
One of the things that we have at Pareto is an employee benefits department, where our employee benefits department can come out, review your group pension, your private medical, your death in service, your income protection. One, make sure it's fit for purpose. Secondly, make sure it's cost effective. One of the companies that Joe, who's head of the employee benefits team, looked at last year, he saved one of the companies £130,000 a year by switching the pension to a salary exchange. Yeah. Now, I know that company used some of that savings to protect themselves for cyber attacks.
Okay.
But the flip side of that is, because they've de-risked themselves, they expect the multiple when they do exit, which they think will be 5 to 7 years, to increase from roundabouts 5 to possibly 7, because they're looking at de-risking. So you've got the double whammy of the multiple of value increasing, but also he's just added £130,000 straight in the bottom. Right now it's not 130 because there is a cost of cyber insurance. Yeah. But even if it's 120, 110, it's a double whammy. Yeah. So if there's anyone out there concerned about this, we're more than happy to speak to anyone.
We've got the poll, which we didn't go through as well. Do you want to go through the poll in terms of the results? So the first one was, during periods of geopolitical uncertainty, what is the most important to you from your financial advisor or investment manager? And there's two. We've got a tie. Proactive communication and reassurance. We're hoping that we've done that today. Yeah. The second is quick tactical adjustments. And as I touched on, from our perspective, that's what we're doing all the time, taking profits on our positions that have done well, whether it be Japan, emerging markets, or commodities.
Can I just butt in here?
Of course you can.
I mean, that's one of the great things about having the relationship with Lunar as well, that if there is anything that concerns to any of our clients, we can speak directly to the chief investment officer, the investment managers. So if there are any concerns, we get communication on a weekly basis from yourselves about what's happening within portfolios. Not that I'm trying to push Luna, but one of the benefits of working so closely with yourselves is we can be a lot more proactive in terms of getting that information out there.
Yeah, and look, from our perspective, having worked at bigger discretionary managers in the past, what tends to happen is you get people making decisions centrally. They then have to communicate that and sometimes convince the investment managers to be able to do that decision.
And go through compliance.
And then make sure it's done. And it can take maybe 3-4 months to go literally for those two stages. Whereas what we did when the conflict started is we sat down that Monday morning. Do we want to do anything? Let's rebalance. Let's take profits. Let's get ourselves organised. Do we want to launch a structured product? Because they tend to be good opportunities to launch structured products. And we could be done as a team within Luna very quickly and very organised, and equally all aligned as well in terms of what we want to do, so everyone's on the same page. So from our perspective, it's great that we have this relationship, but we're also, it's good for us that we've got this very centralised process as well.
Good.
So the next question is, what do you think is having the biggest influence on markets right now? And geopolitical events and global conflicts is the winner. Unsurprisingly, economic fundamentals, growth, inflation, interest rates has come close second. In periods of political conflict, what do you think is the biggest risk to long-term investment? Well, we've got a triple tie here. Market losses themselves, reacting too late rather than too early, lack of a clear long-term plan. I think I'll let Chris answer. What do you think about that? In terms of periods of political, what do you think is the biggest risk? So market losses themselves, reacting too late rather than too early, lack of a clear long-term plan.
I think in a way, they're all interlinked. If you haven't got the long-term plan, that's when you may react in the wrong way, because you think you're trying to maybe achieve something that actually you don't need to. If you've got that long-term plan, which we've spoken about, when we build these plans, we don't assume that markets go up, like step by step each day in a nice straight line. We factor in that throughout the long term, there will be periods like this, and that's why the plans are set up as they are. So, in a way, certainly from our side of things, I know underneath the hood with the portfolios, there'll be tactical adjustments, but for us, we would certainly not be making rash, significant changes with clients because of what's going on at the moment, because it's built into the plan. The clients who knew that they had a cash need coming up in the next month or two, that should have already been earmarked, so we're not having to worry about that. And actually, for the clients that are drawing an income, or for the clients that aren't taking anything, there's a longer term strategy in place that is there to cushion times like this that mean we don't have to react. So I think the kind of, I suppose, concern about reacting too late, sometimes it can feel like that. I think if you go back to February and early March, naturally there's a lot of regret, because you think, if only I'd at the end of February done something. And that's where I think probably that concern of reacting too late. But then suddenly if you do react later, or react at all, actually you can put yourself in a worse position.
I think that's the main theme for today. Actually, don't let short-term volatility impact your long-term goals, because actually sometimes doing nothing is the difficult decision, but actually it's the correct decision. Because in and out of market timing, George Soros, we all know the impact that's had. Actually, sometimes the bigger decisions is sitting tight and waiting for the markets to recover. I remember in COVID 2020, and people were saying, why aren't we 100% into this market? And it's just not short-term volatility. And about 18 months later, they're going, thankfully, we didn't do that. And it's about sometimes sitting tight is the most difficult decision.
Well, if you go back to thinking about it more recently, if you go back to the beginning of last year, everyone just wanted to talk to me about the US and tech. And we said, well, no, we're in UK, we're in Europe, we're in Japan, we're in emerging markets. We're not just buying US technology. And thank God we did, because everyone was saying we look like a bit of an idiot, to be honest, because you should only just have US and you should only have AI, but they weren't the best performers last year. And who knows what's going to be the best performers this year. It's been an interesting start, hasn't it, so far? But it's always about having that diversification, because you don't know what's going to come through and what's going to, geopolitical events like this. Who would have saw this coming? Early February, let alone early January. So it can come along, and then it's the economic consequences. So because most of this oil goes to China and Asia, those countries have actually been potentially hit hard as well, not just Europe, because of the natural gas prices that we take.
And I think sometimes as well, you assume that most people think rationally, and therefore you look at what's playing out, and you say, well, surely Donald Trump wouldn't do X, Y, Z because of X, Y, Z, but that's what a rational thinker would do. And I think he's shown he doesn't think particularly rationally, and so therefore you're trying to second guess based on what you think makes sense, but a lot of what decisions in the last haven't made any sense at all. But that's what you're dealing with. So I think trying to even as things play out, then second guess what may or may not happen, it's really difficult. So I think I said last time, switch the news off and with the weather now, get out in the sun and ignore it.
And I think the other thing, private investors, they generally look at what's the best thing happening today. Oh, the FTSE's at the highest, I'm going to go into the FTSE. Well, they should have looked at that 2 years ago. Sometimes swimming against the tide as opposed to swimming with the tide. If you've got a well-diversified portfolio, is the correct answer.
Yeah, exactly that. And and you touched on it, rebalancing, taking profits and putting them into the areas that are weaker. So you're ready for that when it comes through. Exactly. We got one more question here as well. Sorry. Right now, how do you view holding higher levels of cash? And most people have said, I'm unsure. We've had a third of people saying essential given current uncertainty. What's your view on holding higher levels of cash at the moment?
Yeah, I personally wouldn't. Certainly on the planning we do, wouldn't view cash as a tactical tool, which probably differs to how you might view cash. For us, cash is an important part of the overall picture. When we're talking to clients about their investment portfolios, often the first discussion is around what's your cash position look like outside of maybe what we can see, because that is really crucial to one, how much risk you can take in the investment portfolio, but then also about that timing of when you might need draw on the investment portfolio. So certainly for us, I think the role of cash differs as time goes on. You know, if we've got people still in the kind of saving stage and have a regular income and don't need to access their portfolios, then yes, there's always a need for cash, but probably not as big a pot as someone might need is if they're about to enter retirement or are in retirement. But certainly, you know, we wouldn't be kind of advising clients, let's hold back now and keep a bit more, you know, in cash with everything going on. It's, as I said, it's always about the longer term.
I'd also add to that. I think people talk about holding cash. Sometimes it's not about just holding deposit cash accounts. It depends how you hold them, what structure. Because if you're just holding cash within a bank account and you're getting 0.5% return, but also it's getting taxed at your marginal rate of tax, that might not be the right reason, because inflation is going to erode the true value of it. There are alternatives. We can put wrappers around it. You've got offshore bonds where you can get a higher interest rate, and we can protect it from the tax on a day-to-day basis. We've got things such as government gilts that you can hold, and you can use that as a portfolio.
And just on that, I mean, because that chart that I showed earlier of interest rate expectations shooting up in March, then government bonds sold off in March as well. So the 10-year UK government bond today is around 4.8, 4.9. Shorter dated bonds a bit less than that, but a bit more attractive entry point, making the tax efficiency even better. And the important point with gilts is you're borrowing money from the government, they're lending it to them, and they're very liquid. The most liquid instrument that's in the investment market that you can buy. You can buy and sell them in a day. So if you change your mind, you want it back, there you go.
So it's about how you hold cash and also what are the alternatives to it as well.
Yeah.
So thank you everyone for today. We'll just wind this up. A key takeaway from today's discussion from myself is that successful investing is less about making those big, bold, single direction calls. It's more about having what's the long-term, taking a long-term view, building a resilient portfolio, and also making sure that you're looking at those changes and rebalancing on an ongoing basis. Also tied into that with clients, making sure that you're reviewing your risk profile, making sure that it's the correct capacity for loss, but also looking at the tax wrappers. Legislation's changing, the environment's changing, people's objectives and priorities are changing, so just keep on top of where you're at. And it's a little bit like sailing. You know where you're starting from, you know where you want to be. Sometimes a storm hits, and all you do is go down, bunker down the hatches, wait for the storm to subside, and then replan. I'd like to thank our panel today, Chris, as always, and Alex, for their insights and your opinions. Hopefully everyone's taken something away from it today. I hope you leave today with a clearer sense of not only where markets are heading, but how that may impact your portfolios and your perspectives over the forthcoming months. We have a quarterly webinar. Hopefully you'll join into that. And if there's anything you require, as always, feel free to speak to your advisor or Pareto, and we'll help out as we can. Thank you for your time.